Turning now to today's PCE data and what to expect from next week's Fed meeting, the Conference Board's chief economist Dana Peterson joins us here on set. Dana, welcome to the show. Great to see you.
Thanks.
So are you expecting a pause? What sort of commentary do you think we'll hear from Fed Chair Powell afterwards?
We are expecting a pause next week. Indeed, Fed Chair Powell and a number of other governors and presidents have indicated that they've seen enough in terms of slower inflation. And they're also concerned about the run-up in bond yields and how that's intensified financial conditions.
So are you expecting that this to be a pause? In other words, there could be another hike in the offing, in the coming, or that this is probably the pause that ends this cycle?
Well, there could very well be another hike. Certainly, we're looking at December. And if we continue to see data come in as strong as it has been, we saw third quarter GDP come in very strong. What's the tracking for the fourth quarter? But also inflation and labor markets. We're going to get 2 more inflation reports and labor markets next week. If those are still very strong, the Fed might consider another hike.
So a lot of times we see, they might have, let's say they pause. Do you think the rhetoric will be hawkish or dovish? What do you think they're going to say?
I think the rhetoric has to be hawkish because the moment they go even a little bit dovish, you'll see mortgage rates come off, housing market come roaring back, financial conditions loosening, and markets really expecting that rate cuts will be right around the corner. So the Fed needs to keep the heat on.
Dana, first of all, thanks for joining us. Do you think that the Fed is concerned about the move, the aggressive move in the long end of the bond market? Because, again, by any measure, this backup in rates has been something that has had technical components to it. There's maybe even some fundamental dynamics. There's some inflationary dynamics. But the Fed, as we all talk about, orderly moves in the bond market are fine. Disorderly, and how do you feel about this move? How do they feel about this move? But I'd love to hear your view, too.
I think they may be a little bit disturbed by it, just given the fact that it's happened so quickly. But I think it's also fundamental. Certainly, we are seeing some cracks in the facade of the labor market. Consumers are becoming more indebted. They're falling behind in their credit card payments. And certainly the banking sector, I don't think it's out of the woods in terms of future risks, especially with regards to consumers as well as CRE. So with all of that, I think markets are expecting, yes, the Fed means higher for longer, but I think that realization just came way too quickly and certainly was disruptive for markets.
When do you think the consumer cracks?
When? Well, we still have a recession call for the first half of next year, and that's really when we're going to see negative consumer spending, probably zero payroll gains, and even businesses pulling back not only on investment, but maybe letting a few people go. The key thing is that many businesses think that this is going to be a short and shallow recession, so they're not really letting people go. But you really do need the labor market to soften in order for this to really work.
So is there a rate you're thinking that we're going to hit?
In terms of the unemployment rate? Yes, we're thinking 4.2%. That's notably higher than 3.5%, and it's roughly 700,000 job losses.
Wow. What has surprised you about the trajectory of the economy this year? Because I feel like everybody has gotten it wrong. And I'm just wondering, when you look back on it, what'd you get wrong? So what is sort of the unknown that you're thinking, that's the asterisk in my forecast?
Well, certainly we did get, I think, underestimated the power of consumer spending. Consumers still had quite a bit of excess savings, and consumers weren't shy about pulling out their credit card. So we still had a lot of spending. But I think some of that's going to cool off. And again, you have student loan debt coming online that's going to affect consumers who are 35 and 50. Those are your peak spending years. And certainly we're starting to see many consumers, especially at the lower end of the income spectrum, still complain about inflation, but also higher interest rates.